Good day. Welcome to another session of Fog Accountancy Tutorials. Today we're going to continue our study on IAS 41 Agriculture. Now, in a previous video, which is the part 1, we looked at the overview, the scope of this standard, and then we looked at the key terms such as agricultural activity, biological assets, and then agricultural produce. We also looked at the recognition criteria for biological assets and agricultural produce as well. And then we solved a question that involved a classification of this standard and then where other standards come in. Okay, now in this video, I promised you that we are going to look at the measurement criteria for biological assets and that for agricultural produce. And then we'll look at some other terms and important points to note. And then we'll solve a question that will help us understand better. And so without wasting my time, let us move on straight away to the measurement of these terms, the biological assets and the agricultural produce. So let's look at the measurement criteria. Measurement of, now with a measurement, even though the measurement of these two, I mean, we are dealing with two assets here, biological assets and agricultural produce. Now the measurement, even though is similar, there is a thin line between them. There is a slight difference that I want to explain. So let me first deal with the measurement of biological assets. And then from there, when we understand, we'll look at the measurement of agricultural produce. Now, according to IAS 41, biological assets should be measured at fair value, less cost to sell. Okay, so biological assets should be measured at fair value, less cost to sell. Now, the concept of fair value has been defined over and over again in our previous videos. But then I'm still going to explain. Fair value has to do with the amount at which an asset will be exchanged between the knowledgeable and willing parties in an arm's length transaction. That is fair value. The cost to sell has to do with the cost you incur in selling that asset. And the standard IAS 41 says that the measurement of biological asset should be based on the net realizable value, which is the fair value less cost to sell. Okay, that is what the standard has provided. Now, the only exception to this is that the standard says that biological assets should be measured as fair value less cost to sell. Then there is a clause, unless the fair value cannot be measured reliably. So there is an exception clause. The exception clause in this standard is that except fair value cannot be measured reliably. I'm making it caps. So the standard says that at all points, every point in time, biological assets should be measured at fair value less cost to sell, except fair value cannot be measured reliably. In which case, then it will now be the fact that now the standard says that if fair value less cost to sell, the fair value cannot be measured reliably, then we can switch and then measure biological asset at its cost, less accumulated depreciation or accumulated impairment losses. So in other words, those of you who know IAS 16 very well, you know about the cost model and the revaluation model or the fair value model. Now what we are trying to say is that the measurement of biological assets follows the fair value model or the revaluation model, except the fair value cannot be measured reliably. And then we switch to the cost model. So there are two options, but it is ranked in the scale of preference. Okay, that the measurement of biological assets should follow fair value, less cost to sell. Then the exception clause is that in a case where you don't have a measurement that is reliable for fair value, then you adopt the cost model, and then every year you take out accumulated depreciation and accumulated impairment losses, if any, so that you now switch from the fair value model to the cost model. That is how we measure biological assets. Now, that is quite different from the measurement of the agricultural produce. So let's turn our attention to the measurement of agricultural produce. Now, when it comes to the measurement of an agricultural produce, it is strictly the fair value less cost to sell, and there is no exceptional clause. I'm going to tell you why. So it is measured at fair value less cost to sell. Now, you see that both of them have the same measurement criteria, fair value less cost to sell. But when it comes to the biological asset, there is an exception that in a case where you cannot measure your fair value reliably, then you look at the cost of acquiring the biological asset and then you depreciate it every year to reduce the value. However, when it comes to agricultural produce, the standard is of the argument that because agricultural produce are ready for the market and therefore fair value can always be measured reliably. There is no case where you can have an excuse that you could not measure the fair value reliably for an agricultural produce, because we said that an agricultural produce is a finished goods that is ready to be sold on the market, and because it's ready to be sold, you have a price tag for that. Okay, so there is no way there will be an exception clause that is telling us that in a case where we cannot measure fair value reliably, then we should switch to the cost model. No. So there are two different things, even though they are all having the same measurement criteria. However, there is an exception clause to biological assets, because it is not all the time that you can have the fair value measured reliably for biological assets. And we say that in such an instance, we switch to the cost model. However, with the agricultural produce, because it's a marketable produce, we are saying that every marketable produce should always have its fair value being measured reliably. And therefore, there is no exception. It's strictly fair value less cost to sell. That is how the measurement is done for an agricultural produce. I'm sure that this is very understandable and you understand why there is a clause here, but there is no clause with the agricultural produce. Okay. Now, there are other points to note, which I'm going to give you. I want us to deal with the practicals, and then we'll look at those theories and the disclosure requirement. Now, the other thing that you should note is that once we are going by the fair value model, then it means that every year we are going to test it for revaluation. And by testing it for revaluation, you can get a gain or loss on revaluation for both the fair value and then agricultural produce. However, we don't expect the agricultural produce to be in the organization for a very long time, because normally once you harvest it, you are ready to sell. So usually agricultural produce would be classified as inventory, except maybe it's going to stay for a long time. Okay, now when it comes to the biological asset, it's going to stay for a long time for sure. So it's definitely a non-current asset. This could be a non-current asset or a current asset, depending on the time that is expected to be sold. There are some agricultural produce that will be harvested and be there for more than a year, maybe depending on the nature of the asset and the requirement for sale. Okay, now what we are saying is that once you have the biological asset or the agricultural produce, and it is using the revaluation or fair value model, then it is likely that every year you are going to have either a gain on revaluation on those or a loss on revaluation. Now, if it is a gain on revaluation on either the initial recognition, I'm starting with the biological asset. If you have a gain on revaluation for the biological asset at initial recognition or subsequently, those gains or losses should be recorded through the profit or loss or the statement of profit or loss. So gains will be increasing the profit and then the loss will be decreasing. They will all be recognized through the statement of profit or loss, just as we do for property, plant and equipment and other valuations of non-current assets. When it comes to agricultural produce, it's the same. Any gain on the agricultural produce on revaluation is recognized through the statement of profit or loss, and the same for a loss. Okay, we are going to take a question to that effect to make you understand what I mean by gain or loss, and then even with the measurement criteria. So without wasting much time, let us look at this question and let's solve it together. An entity has these balances in its financial records. So we have Ghana cedi in millions. So value of biological assets as at December 31st, 2022, we have 600 million. And then we have fair valuation surplus on initial recognition at fair value. 31st December 2022, that is 700 million or 700. Then changes in fair value to December 31st, 2023 due to growth and price fluctuations is 100 positive, and then decrease in fair value due to harvest is 90. Required: show how these values would be incorporated into the financial statement at December 31st, 2023. So this is purely a question of measurement. They have given you the initial measurement value, they've given you an additional value from the previous year, then they've given you a gain and they've given you a loss on revaluation. So how are you going to incorporate these values in your financial statement? These are all measurement issues. I'm going to clean this and I'm going to help us solve it together. Okay, let's go back to the question and look at the issues here. Now, an entity has these balances in its financial records. The value of biological assets at cost on December 31st, 2022, 600. Now, December 31st, 2022 is the same as 1st January 2023. Remember that as we move on, you see that the other changes happened in 2023. But they gave us the opening balances. Those were given us December ending for 2022, but they will become the opening balances for 2023. So that is how it's going to be, and that is that value of biological asset is in disguise the balance brought forward for the biological asset from the previous year. Now let's go back and look at what is next. We are told fair valuation surplus on initial recognition at fair value on the same December 31st, 2022 is 700. So in other words, at initial recognition from the previous year, because we are dealing with 2023, the question is asking us how to treat it in 2023, and they are telling us that in 2022, even though the opening balance was 600, there was a fair valuation surplus of 700 that was added in the previous year. So that will be an addition, right? And it's all coming from the previous year, so that becomes the opening balance as well. So in other words, we can add both of them to become the opening balance, because if there is an initial cost and an additional valuation surplus from the previous year and we are dealing with this year, both will stand as an opening balance from the beginning of this year 2023. Okay, now let's move on. That is 700. Now in this year itself, changes happen. A change in fair value to December 31st, 2023 due to growth and price fluctuations. So this same biological asset, which was initially fair valued as 600, rose up by 700, not to 700. There's a difference between rising up by and rising up to. Rising up by means that is the difference that is being added. Rising up to is that it has moved from one point to that point. So you find the difference yourself. So it rose up by 700, and in the current year it has gone up again by 100 because of price fluctuations. So you see how revaluation model keeps changing the value of these biological assets. Now let's look at the last point, which says that now there is a decrease in fair value due to harvest. So when we were harvesting, I mean, there were certain things that we did that has decreased the fair value by 90 cedis, even though we have Ghana cedi in millions. Okay, so 90 million. Now, the question is, show how these values would be incorporated into the financial statement for December 31st, 2023. So that is what we are supposed to do. We're going to show how these values that we have mentioned in a scattered way will be organized and presented in the financial statement. And we'll know that, because when we come to measurement, we are looking at the value to be incorporated in a financial statement for the year end. And then once there are gains or losses, we are going to look at the effect it will have on the statement of profit or loss as well, just as I mentioned. So let's look at this. So this is how it's going to be. So you present it in a very nice way. This is in millions. So you start with your initial biological assets value as at 1st January 2023 was given as 600. Now coming from the previous year, there was fair valuation from the previous year, which was an increase. Okay, so also at 1st January 2023 it was 700. I told you. So you add these two and you have 1,300 million. So that is the opening balance as at the beginning of the year for the biological assets. In other words, it is the carrying amount. So carrying value or carrying amount of the biological asset as at 1st January 2023. So these two existed from the previous year. So in combination, we have our opening fair value. Then we look at the changes that happened this year. Remember, there was an increase of 100 and there was a decrease of 90. We are told that changes or change in fair value to December 31st, 2023 due to growth and price fluctuations. So the growth there gives us a signal that there was an increase of the revaluation by 100. And then we are also told there was a decrease in fair value due to harvest by 90. A decrease means it's a reduction. So sometimes they may not even put it in brackets, but the terms that are used should give you a clue as to whether there is an increase or a decrease. Okay, so we can say that changes in the fair value within the year 2023 will be recognized as 100, and then the decrease in the fair value, which is 90, will be put in brackets because we are subtracting. All that we are doing, the purpose is to find the fair value or the carrying value of the assets at the end of the 2023 financial year to be included in the statement of financial position. So therefore, the carrying amount or carrying value as at 31st December 2023, that should be incorporated in the financial statement, should be 1,310. This is the value of the assets at the end of the year, and this is the presentation the examiner expects you to give. All right, so this is very simple. Now, we are not done. We are also supposed to look at how the changes will affect the profit or loss as well. So you have to show that effect in a financial statement, or so the income statement or the statement of profit or loss. Now, in your income statement, you are going to show the gain, because remember that at the beginning of the year, we have 1,300 as the carrying amount of the asset. At the end of the year, we have 1,310. So basically, there is only an increase of 10. But the increase is explained as 100 minus 90. And so you have to just show that there is going to be an increase, because if your income statement or your profit or loss account does not increase by the 10, your statement of financial position will not agree, because we know that assets should be equal to equity plus liability. Now, there has been an increase in the value of assets by 10. Therefore, there should be an increase in the value of equity by 10 to make it agree. The value of equity is going to increase through the profit or loss, the income surplus components of the equity. So once there is an additional 10 that is changing from last year's account, then there should be an increase in 10 in your income surplus. Accounting is very simple, and some of these things shouldn't be a problem. You can't show this without showing the effect here. So therefore, you can say that the changes in fair value will come as 100, and then the decrease in fair value will come as 90. So then you show 10 as your net gain on the biological assets. So you do this and then you have your full mark. This is a very simple question, but it's a question that is testing your understanding on measurement of biological assets. You could also get a question that is testing you basically on agricultural produce only. Okay, I'm sure this is very understandable. This will bring us to the end of the part 2 of our video on IAS 41 agriculture. Now in the part 3, we are going to look at some summary points to further highlight on the measurement, and then we'll look at other concepts to take note of, like government grant issues and other issues, and then we'll look at the disclosure requirement as well. Then we can begin to pick questions and solve them as past questions. Remember to subscribe to this channel if it is your first time. Share this video and let others also have a benefit. And until we meet again for another video, it's bye for now. Thank you.